The concentration of global stock markets has increased significantly over the last decade. The US share of global indices has risen considerably, reflecting in part the far superior earnings growth from US-listed businesses. This has driven valuations to a premium and in turn attracted a greater number of non-US businesses to the US stock market. This is evidenced by the increase in the ratio between the size of the total stock market capitalisation and the country's GDP, which has risen from around 100% pre-financial crisis to over 160% today, based on data from Bloomberg. The dominance of the largest companies within the index has also increased dramatically over this period, with many measures of concentration at the top end of markets comparable or even exceeding that of the extreme periods seen over the last 100 years of market data. Trends such as this have significant implications for asset allocation and stock selection, and today we discuss this topic, amongst others, in the context of one of the oldest and largest equity investment managers globally, Capital Group. Welcome to the Investor Insights podcast, hosted by Killik Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on topical issues. You can access the full series of interviews via the playlist on the Killik Co YouTube channel, or by searching for Killik Co's Investor Insights on Spotify, where you can subscribe and be notified of future episodes. We hope you're enjoying the discussion so far, and you can get in contact with us about any of the topics discussed via the email address investorinsights@killik.com. Killik Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan and invest. And you can find more details on the unique ways in which we do that at our website killik.com. In this episode, we were joined by Richard Carlyle at Capital Group. Richard is an equity investment director and portfolio strategy manager at Capital Group with over 40 years of investment industry experience. He's been at Capital Group for the last 18 years, but was previously Head of Equities at Henderson Investors, as well as having several fund manager and analyst positions, including at Morgan Grenfell Asset Management. Capital Group was founded in Los Angeles in the 1930s and is one of the largest investment management organizations globally, managing more than $2.5 trillion. The long history of the company means it has strategies which have been run with a consistent investment process across multiple economic cycles. This includes the company's New Perspective Fund, which we reference in our discussion, which celebrated its 50th anniversary last year. Looking back over this long history is insightful in putting this current changing market environment in context. Richard, thank you for joining us this morning. How are you doing today?
I am very well, thank you, Gordon. How are you?
Yeah, very well, thank you. So our standard opener, our kind of usual first question is one that tries to get a little bit to know you really and kind of what you've been working on recently or kind of interesting things that you've come across. So I wondered if there was a kind of anecdote from a company meeting or a book that you'd highlight or an article that you've read recently that you could share.
Well, it's an interesting first question. I was actually going to cheat and slightly go back in time. So I've been at Capital 18 years, and so this is quite an old story, but one of the first retreats I did was a retreat to Silicon Valley. And if you rewind 18 years, I think that's just pre the launch of the iPhone, so that frames it. And it was one of the most memorable company meetings I'd had, in that Alphabet, or Google as it was then known, had been quoted for a few years. Capital were serious investors in Google, and this was my first meeting. At the time, Eric Schmidt was the chief executive of Google, and we all go to Google campus in Silicon Valley, and there's about 20 of us in a room, and he walked in, and his opening words were something like, "Hi, I hate meeting shareholders. It's a complete waste of my time, but your Capital, I'm told I have to be nice to you. You have an hour," sort of thing. And he then proceeded actually to spend 2 hours. And it was one of the most interesting. I'd come from another fund manager before, we'd never managed to meet Google. And there was one question that our analyst was an Indian guy called Irfan Furniturwala. He is still at Capital. And he asked Eric about why they were launching Google Maps. He said, I just don't understand how you're going to make money out of Google Maps. And Eric said, Irfan, imagine you're wandering around San Francisco and you have a mobile device and you want a nice cup of coffee. You go to Google Maps, you search for nice coffee houses, and up comes a list. How much do you think the coffee houses will pay to be top of that list? And it's like a light bulb moment where suddenly you thought, now I understand why they're launching Google Maps. Now I understand how it'll make money. And in a way, the serious point is that, access to top chief executives is very valuable. You're not getting inside information. You're just getting insights into the way they think. And that's always struck me as a great example of a company meeting that sort of, had a sort of light bulb moment for me. So silly story, but I thought I should tell it.
No, very good story. Yeah, what a first meeting. Thank you for that. And then think of today, and I'm not sure there's a day that passes without me using Google Maps at the moment. So.
I agree. Yes, we're lost without it, literally.
And so, Richard, I thought for the first kind of proper question, it might be helpful just to provide a bit of an intro into the New Perspective strategy and Capital Group in general. Really, we've got a long history, obviously, of running money. But could you maybe just kind of briefly describe some of those kind of typical company characteristics that you're looking for, and have done for the duration of the strategy, really, and kind of give a bit of an intro into how that strategy has evolved over history?
Sure. So as you say, New Perspective is, I think it was 50 years old last year, and it's been run in a reasonably unchanged way throughout its life. We started with 3 managers. We have 10 or so now. So it's grown in terms of number of managers. But the objective of investing in companies that benefit from changing patterns of trade has remained the same. And we define trade very broadly. It's not exports and imports. It's, if people stop shopping in the high street, shopping online, that's a changing trade pattern. And that's been consistent. We sort of interpret that through the lens of multinationals. So we filter out sort of purely domestic companies. So there are no sort of pure domestic Japanese banks in there or, Italian retailers. They all have to have a quarter of their revenue outside their home market. And that's been a very consistent approach, to be honest, throughout its history. And there are people that try and compile indices of multinational companies. I think FTSE have one. They use a slightly different definition to us, but there is evidence that multinationals over long periods have done better than broad indices. So we have that little tailwind, and obviously we're trying and so far succeeding, I think, in adding some alpha on top of that tailwind. So that's been the unchanged objective for 50 years.
Yeah, great. That's helpful. So as you say, kind of over 50 years, that strategy's gone through kind of various market cycles and various kind of changes in the economic and the market environment. I mean, one thing that, obviously you've kind of laid out that strategy of focusing on multinationals, but I'd be interested in how you kind of approach kind of getting balance and diversification in the portfolio, given that kind of focus on multinationals. How do you approach kind of creating a portfolio to navigate the changes in the economy and the changes in the market environment?
No, it is a good question. And, one of the good things and the bad things about capital is we have a pretty unique way of running money, which is good in a way, but often it's difficult to explain. And I think it is the capital system that provides that balance. So, what we have in New Perspective is 10 sort of named portfolio managers, each running a slice, and then an analyst portfolio. And the 10 individual managers are given the brief of, never mind the indices, never mind the benchmarks, just choose your highest conviction ideas for the long term. Now, that sounds simple, but I think what we all struggle to get across is the difference of their individual sleeves. They're different by number of holdings. We've got one manager who's got 15 or 16 holdings, others have got 70 or 80. Some have got massive exposure to commodities, some have got none. So they're really rather different underlying portfolios, and capital's job is to blend them together. So that sort of, diversity and lack of focus in one area is because of the capital system. And to the extent that if we suddenly found that we had 2 managers with really identical portfolios, that would be a reason for us to change the manager team slightly. That doesn't add diversity. So the capital system and bringing through the next generation of managers with different perspectives, different tolerances for high valuation, low valuation, etc., is the key to the capital system. It's the diversity of thought, all encompassed in one portfolio.
Yeah, that makes complete sense. Yeah. So I think that's kind of covered off the kind of the history and that kind of long track record of the strategy. If we maybe kind of touch now on kind of more recent developments, and there's plenty going on in kind of economies and markets at the moment. I mean, not least the kind of last 2 years interest rate environment kind of completely changed, and those kind of big technological changes that are kind of gaining traction. I wondered if there were kind of any general themes to how the portfolio's changed to address those kind of market trends over recent years. Would you be able to summarise those?
Yeah, so I think there are a couple spring to mind. One is one of the nice things about a 50-year track record is you can make sort of long-term comparisons. I mean, we are at our highest exposure to the healthcare sector in 50 years. And to be clear, that's not because we have a sort of a senior chief investment officer saying, buy healthcare. That is sort of bottom up, and the analysts have sort of have looked at the healthcare companies. They've looked at the potential revenue growth, particularly from the anti-obesity drugs, which are the flavor of the month, etc. But also future drug developments, maybe treatments that stop the progression of Alzheimer's, etc. And in a way, we think we're in a sort of a golden age of drug discovery, and we're not. The holdings are actually quite narrow range. There's a lot of holdings, but where we've got healthcare holdings, they're significant parts of the portfolio. So Novo Nordisk, Eli Lilly, and AstraZeneca are all in our top 20 holdings. And as I say, healthcare exposure as a whole is the highest it's been in 50 years. And I'm afraid the other one is a rather predictable artificial intelligence. We are, I think, like many investors, obsessed with it. And I know some of your other questions will come on to this, but not only identifying the winners, which in a way is analytically not that difficult. The key question is the prices you're paying for them. More interestingly, in working out which industries are losers, where which business models on a 3, 5, 10-year view are going to suffer from having artificial intelligence sort of take away their value add. So that would be the other big one. Our biggest holding is Microsoft. That is a company we think is most easily identifiable with making profits out of AI, but it does sort of occupy analysts across the spectrum at the moment. So,
yeah, I was going to ask you about that kind of threat from technological changes and how you adapt to that. I mean, it's quite interesting. There's a fair few charts which often kind of do the rounds in the financial press, looking at the largest businesses in the market kind of going back over the decades, and the kind of top companies. I mean, there are sometimes companies that kind of last through decades, but often the names change quite markedly. So you get the kind of the largest market capitalized businesses kind of fall off, and others come up. I wondered how you kind of navigate disruption. So you've got a previously successful business model, but being disrupted by a smaller player that's able to kind of navigate things. Are you able to give some examples of how the strategy's kind of guarded against that, I guess, over its history?
Well, first of all, let me fully agree with your statement. So I was in a previous life, I was a UK portfolio manager. I was one of those when Vodafone became very nearly 10% of the UK market. And I remember thinking, this opens the door to mobile communications. This is going to be a huge company forever. Here we are now. It's a high yield, low PE, almost utility sort of company. So these do go in cycles. I think the capital way of looking at that is really long tenured managers. And the thing that interests me is many of our conversations around AI reference the TMT boom and bust, if you like. Now, there are major differences. I think AI can move more quickly than the TMT boom. If you remember, in the TMT boom and bust, we were waiting for broadband to be built out. That slowed it down, whereas broadband is now completely prevalent, etc. And so this AI revolution can happen more quickly. But working out parallels, at the moment in AI, it is the pick survive, the shovel providers, if you want, the TSMCs, the NVIDIAs, the ASMLs, where much of the attention is. But we know the phase changes to the companies that can add AI to their business model and generate extra revenue, which isn't competed away by competitors, sort of thing. So it's looking back in history and drawing parallels with previous technology cycles. I think that's our strength. And most of the managers on New Perspective Fund were at capital and were managing money in the TMT boom and bust. So I think that's helpful to us.
Yeah, no, sure, that makes sense. Richard, can I ask you briefly about valuations as well at the minute? I mean, whenever you get a kind of period where you start to name a group of companies because they've done so well with the Magnificent Seven, you kind of start to question valuations sometimes. I mean, how are you kind of looking at valuations at the minute? I mean, given that there is growth there as well in a lot of these businesses, but obviously we've had a strong run in some of these names. How are you kind of assessing that?
So we're not dogmatic on valuations, and what you find is different analysts have sort of different valuation metrics and different PMs like different valuation metrics. I think one thing that is different this time is just that the profit dynamic of these platform companies is rather fascinating. And just imagine you're Microsoft, and just imagine, you can persuade one user to pay $30 a month for the AI add-on to their Microsoft suite of Teams and Outlook, etc. Much of that $30 a month is extra profit, and there are some costs in extra processing power, but versus $30 a month, that is a small number. So you are in the situation where Microsoft can add on new subscribers, all paying $30 a month, and much of that flows to the bottom line. It's a bit like Netflix. So when they add a new subscriber, there's very little extra cost, and much of that money flows to the bottom line. So I think when you look at valuations, you have to remember that metric. It's not like a manufacturing company. It makes another widget, sells it for 100, but got costs of 70. It's selling it for 100 with costs of 1 or 2. So I think you need to bear that in mind when you think about valuations. Then that arguably will allow valuations to go very high. I mean, an NVIDIA, it is just a designer of chips. The manufacturing is all done by TSMC. So that too has got a different profit dynamic from a traditional manufacturing company that we all think of through history.
Yeah, very important point. Yeah, no, thank you for that. I thought we'd move on. I mean, Capital Group's kind of really very highly resourced. I mean, you've alluded to that with the kind of PMs in previous questions, but we've actually been fortunate ourselves to hear from a number of your kind of specialist research analysts or kind of advisors, one of which was a specialist in US politics. And I wondered if we are in a year which is important for US politics, and I wondered if there were kind of any kind of recent observations from those sorts of advisors or others that I know are kind of feeding into the approach, kind of those specialists within the team.
Yeah, so you're referring to what we call capital strategy research. We abbreviated that to CSR, and Matt Miller, I think, is our US political analyst. Agree, he's absolutely fascinating, and we all listened intently. I think it's important to say that a PM will not sort of say, I'm going to buy stock X, Y, and Z because I believe ABC is going to win the election. In a way, we are trying to build portfolios that will do well, whatever the election outcome. But yes, this US election looks even more interesting than many, even from a UK perspective. I think, so first thing to say is there's no evidence in history that Democrat or Republican markets are better than each other. They've both done pretty evenly over history. We are used to the normal volatility in the run-up to US elections. Often, say, the healthcare sector, which gets a lot of discussion in the run to elections, can be quite volatile. But I think this time around, I think we need to be wary about discussions around the independence of the Federal Reserve. And that's quite a big topic. That's a sort of entrenched independence, and any threat to that would produce a bit more volatility. And obviously trade with China, that's going to be a topic as well. And I think they're well known about, well discussed. Maybe independence of the Fed is less discussed, but I think we are ready for that. But the key thing for us is to have a portfolio that will do well, whoever is the next US president.
Sure. Richard, we've kind of touched as we've gone through on healthcare and some of the technology names. I wondered, one other kind of big theme that's out there is the energy transition. I wondered kind of how Capital Group are approaching that, because you've obviously got the kind of commodity side of that, but also the kind of electrification side, and various different kind of bits and pieces, all with different kind of drivers to them. How do you approach that with that kind of multinational look on things?
So we agree it is a fascinating theme. I'm lucky enough to do client meetings around the world, and there are such different views on that around the world, but that's another topic. I think there are a few things. I mean, some of our top 20 holdings are part of the thesis is around an energy transition. We own shares in Caterpillar, for example, manufacturer of big yellow earth-moving machinery, etc. Part of the reason for that is if you imagine electric charging networks being rolled out around the world, there's lots of digging up the roads, there's lots of heavy infrastructure, and Caterpillar should benefit from that. They've also got a bit of a technology transition from self-driven trucks to remotely driven trucks, which makes them more a provider of earth-moving services rather than the cyclical lump of yellow metal, if you like. So we think that's quite interesting. And then within the energy companies themselves, you see such a range of views within the energy companies about the attractiveness of green energy investments. And our analysts have, and our views have changed on this. What are the returns from green energy investments? Companies like Total have put more money into that than some of the US companies, and our analysts are trying to work out, what the likely return from that is. I think we are optimistic about the green energy transition. There's huge public opinion behind it, less so in the US. And I think we would expect long-term government support for green energy. And just imagine one day Amazon announces that their entire supply chain is carbon neutral. Then the pressure on other people with long supply chains to follow that, we think would be impactful for the energy companies. So interesting area, and one where there are such different views around the world.
Yeah, for sure. Richard, our standard final question. We have a standard opener and a standard final question, but it's one that asks the speaker for their highest conviction area, and I hope that's not the kind of the trickiest question that there is. I appreciate it's kind of a very much a portfolio approach here, and it's the power of the portfolio. But would there be one area or one company that you have a particularly positive stance on at the moment?
Well, I'm going to cheat and say that I'm torn between the sort of anti-obesity drug companies, so Novo and Eli Lilly, and then the AI chip manufacturers. And let's leave NVIDIA to a side to a certain extent, because NVIDIA's position in three or 4 years is probably less certain than TSMC and ASML, which have been long-standing holdings in the fund. And the reality is there's only TSMC that can make the cutting-edge chips that AI needs, and they can only make those chips using ASML's machines. No one else can make those machines. So here are two companies with close to 100% market share of a technologically advanced area that no one can compete with. That's a very good environment for pricing. If no one else can make what you can make, that's rather good for your pricing. And we struggle to see anyone catching up with either TSMC or ASML. So they've been top sort of 10 holdings in the fund for a while. So whether it's weight loss or TSMC, ASML, I don't know. I give you both. So
that's good enough for us. Yeah, thank you. And Richard, thanks so much for your time. I really appreciate it. It's been really interesting talking to you. Thank you.
Thank you, Gordon. Have a lovely weekend.
Thank you for listening to the Investor Insights podcast, hosted by Killik Co. You can get in contact using our podcast email address, investorinsights@killik.com. For more information on any of the topics discussed, or for further details on the services offered by Killik Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killik Co is authorised and regulated by the Financial Conduct Authority, the FCA.